could lie ahead. But let's now talk about the bull versus bear case because, as bad as the results might have been, it is really not the fact that across the board brokerages are negative on the stocks. We still have many which are positive. So let's introduce two brokerages now. We have HDFC Securities that has an ad call on the stock with a target of 1470, while Nirmal Bang is in the bear camp. They've lowered the target price to around 1200 rupees. Now, HDFC Securities is bullish on the thesis that Q4 can pass off as an aberration, even though macro headwinds still persist. And Nirmal Bang, meanwhile, says that they're bearish and they believe that on the macro front, the worst is really still ahead of us. So let me welcome on this show Apurva Prasad of HDFC Securities as well as Girish Pai of Nirmal Bang, who's actually in the studios with us. Girish, Apurva, thank you both so much for joining us. Girish, let me come to you first. You downgraded the IT sector a long time ago, so that call is absolutely bang on. But tell us from now, you're saying that in terms of macro headwinds, the worst is still ahead of us. In terms of what it could mean for the sector, how much worse do you think things could really get from here?
Yeah, so I think the issue, if you look at what has happened in 4Q, three months back, most TCS and Infosys management were fairly, I would say, cautiously optimistic on how the things would pan out in the near term. But the numbers have turned out to be far worse than expected. And that, I think, is an issue of lack of visibility. So my sense is that that visibility will still not be there unless you have the macro headwinds behind you. So as I've been saying, macro headwinds are ahead of you. I mean, we've still not seen the big event of the US recession or whatever it be, whether it is a shallow one or a hard landing or a deeper one. That is not behind us. So what we've seen is customers reacting in a certain way when US economy has been fairly resilient. If you look at what's happened in 4Q and what looks like a decent number in 1Q, consumers in the US have been fairly resilient. So when things turn bad, how will they react to something you need to kind of watch out for? And the one thing I would look out for, one parameter I would be looking out for is pricing. And if you look back in history, look at the various stress points the industry has gone through. Every stress point, macro stress point that the industry has gone through, we've seen pricing pressure. Thus far, we've not seen pricing pressure. So I would look out for that. I think it will happen. It just requires one large vendor to panic, and then we'll probably see that happening.
Would you liken this to the GFC and what transpired then in terms of weakness?
No, I think this is not like GFC. GFC was largely a BFSI situation, and obviously there was a very sharp decline, and then you saw the Fed come to the rescue. The problem that the industry is facing, which it's not faced ever in the last 20, 30 years, is the high inflation data, which prevents the Fed from going out and doing a very significant monetary stimulus, be it on the normal stimulus side or on the unconventional side. If that doesn't happen, I don't think the sentiment is going to improve, both on the corporate side as also from the P multiple perspective.
Girish, I think also, and correct me if the reading could be wrong here, but I think what's really also shocked the street is that this was two mid-sized banks. Perhaps we were working with the idea that, okay, there could be some sort of, maybe some delays here and there. We're not even in a full-blown recession as yet. Stock markets in the US are firing away. JP Morgan's earnings have been fantastic. We're not even in a real situation, a real problem. And then to see cancellations in Infosys' case, deferrals in TCS, but then cancellations. So is that why there's such huge disappointment? And I'm going to throw TCS's argument back to you. TCS said that at least customers in the US, they're very quick to turn off the tap the moment there's uncertainty, but they're equally quick to turn the flow back on. Now, do you buy that argument from TCS?
Yes, so I think visibility plays both ways. So probably in 4Q, you had a situation the customer where the vendors were kind of blindsided by the reaction of the customers. It could work the other way around too, but the point is it would work the other way around if the ground reality or the macro reality is changing for the better. Okay, as I keep saying this, we're not seeing the worst on the macro front behind us, it's ahead of us. And again, I think the other issue is about FY25. So right now, even I'm building in like a double-digit growth in FY25 because mine is an explicit call for a shallow recession. And I think that somewhere down the road, inflation will come down to 2% or below. And then we'll probably go into another round of a QE. And that is the reason why I'm assuming a double-digit US dollar revenue growth in FY25. Now, if that doesn't play out, there are obviously economists who are saying that core inflation in the US will probably not go below 4%. If that doesn't happen, then Fed is not going to go and do another round of a QE. If that happens, then you're going to see a very shallow kind of a growth kind of come through in even 2024 calendar year for the US economy. And then sales and profits of the US corporates are going to suffer even in 2024. So there is that challenge for FY25 that you could probably see consensus numbers come off. As you know, maybe it could be 6 months down the road, it could be like 9 months down the road.
So right now, this is from what you say, the reading that I gather is this is not really a two banks blowing up problem. This is deeper. This is about a slowing US economy, and this could extend into 2025.
Yeah, see, I think it wasn't so much about the banks. So if you hear the commentary, both the TCS and Infosys had said that even in the early part of the quarter, they had seen pressure. So it was a fairly broad-based kind of a pressure that's coming through. Interestingly, I heard Infosys saying that March was stable. I kind of wonder how that happened. And also, while the regional banks aren't a very significant exposure from an Indian industry perspective, they have an indirect, impact on the U.S. economy because apparently they constitute almost like 40% of lending to the U.S. In the U.S. economy. And if that kind of, I won't say collapse, but it kind of slows down very materially, then it has an impact on the U.S. economy, which then impacts your, Fortune 500 companies from their sales and profits and all that.
All right, got that. Let's also get Apurva Prasad in because he has quite the opposite view on this. Apurva, thanks for joining us. This is Pavitra. We were just going through the bear case, but you're clearly still optimistic on this one. It's a 3.2% decline in the constant currency revenue. You still have an ad rating, and you're saying that this quarter can perhaps, pass off as an aberration. So take us through your call on this. And also, this is at a time when Infosys is clearly saying that across verticals, they've seen deal ramp downs, not just deferrals, ramp downs. How are you still positive on this?
Sure. So while at the outset, I may want to state that we have also cut our estimates, and the Q4 performance was certainly not anticipated. I would certainly call this an aberration. Let me explain what I mean. So we were going with a flat sequential performance expectations. Against that, there has been a decline of about 3.2% or so. Now, if you look at the guide, which is 4 to 7%, we were working with about 5 to 8%. That's what the number that we were expecting, a management guide. There's a bit of arithmetic here. If you look at the cuts that have come in, it's more a function of the exit rate of FY23, i.e. the Q4 performance as compared to the actual growth. Because if you look at what's implied in that 4 to 7%, if you see the midpoint, that's still at about a 2.3% CQGR. Now, this is an average of what they have delivered over the past 12, 13 years. So that's where we are. So which is what I meant by why Q4 seems to be an aberration. So while I agree that the macro-related challenges have only gotten bigger, but I think there are a lot of positives for the sector. So number one being, it's a very unique kind of a macro challenge that we are seeing currently. The labor market continues to be fairly tight. Even if you look at last month's number, it still continues to be above pre-COVID. Which is why it's unique, and it plays into the value proposition of a service provider. Second, the inflationary scenario, again, to an extent, it plays to the value proposition for a service provider, especially on the cost optimization side of these. And that's the commentary we are getting from the company. So while you are looking at a classic disconnect between the pipeline translating into bookings and bookings translating into revenue, let's not forget that Infosys also talked about the deal pipeline, which they see to be at an all-time high. So I think that's pretty. I think that's encouraging for me. The fact that I would say the probability of them doing midpoint of the guidance is reasonably high. And I think also as an exception, I don't really recollect Infosys talking about margin trajectory beyond the year. So I think the fact that this is seen to be probably bottom levels, for margin despite guidance being lowered, I think that's another positive to look at. So I would say that the probability of getting to midpoint of the guidance is reasonably high. And at the same time, I do not see any structural challenge to the operating profile of the company.
So what would be your FY25 estimates, Apurva? If Q4 is an aberration and you're quite convinced that the company will at least be able to deliver the midpoint of their FY24 guidance, that's 2.3% revenue growth every quarter of this year, what can we expect for FY25 according to you?
Yeah, absolutely.
And what does this mean in terms of US macros for the company to be able to recover in FY25?
Sure. So we have our EPS is about 71 and a half, 71.7. We do expect them on top line to get back to double digit for FY25. And let me explain that. So let's say you do 2.3% CQGR, you hit midpoint of the guidance of 4 to 7%. Let's assume you continue at that rate in an environment where macros improve. But even if you continue at that kind of a rate, you get back to a double-digit trajectory. So there's a bit of an arithmetic there, but the point being is that you need to be growing at 2.3% CQGR, and that takes you back to double-digit in FY25. So that's what we're building. So from a midpoint of about 5% constant currency, we expect them to go back to double-digit in FY25.
Gentlemen, I want to ask both of you what this implies for the sector, because if the titans have suffered in this manner, if Infosys is seeing ramp downs, and I don't know how other IT companies in the bigger lot, the tier 2 and then mid cap, what lies ahead for them. So Apurva, you want to take that up, and also just if you could elaborate on that point you made that you were seeing this as a 1 quarter aberration. What makes you confident that it's 1 quarter and the pain won't last longer?
So, Surabhi, if you see historically, and that's a good way to look at what's been the variability in terms of what the company sees themselves growing, what they end up actually doing, and what's been the variability of guidance throughout. So if you again look back last 15 years, from every time they've given out a guidance and where they've ended about 1.5% higher than the midpoint. Okay, that's one. Two, every quarter they do end up revising their guidance either upwards or lower. So 80% of the times that they have given their first guidance, the guidance has either remained unchanged or that's gone higher 80% of times. So that gives you some sense of variability, and this is across sort of cycles. What is giving visibility? The fact that Q1, Q2 are seasonally stronger from a large deal standpoint. The fact that if some of the deals that they do have in the pipeline that converts, that can give them the close to 2 billion net new large deal over the next 2 quarters, which should take them to the midpoint. So I think a large part of it is the fact that some of those bigger deals could convert. The fact that you see on the core part of their business, the core part which they report, which is X of digital, this is a segment which used to decline pre-COVID, and it's been more flatlined. So the deflationary part coming from the core services is not to the extent that it was pre-COVID. So I think that's another point which is going to be helping.
Okay, that is the bull case on this situation. And Girish, you heard that as well. You have any thoughts on what Apurva just said? And, of course, if you want to toss any questions as well.
No, okay, let me just step back and look at the sector. The companies are great companies. The sector has been a significant value creator for investors. My issue is differentiating the company, which is great, versus the stock performance, which I think will be modest and mediocre in my opinion. From a 5-year perspective, ignore the noise around hard landing, soft landing, all that is, it could be like a 12-month, 24-month kind of phenomenon. If you take a 5-year view, you need to understand what rate will this industry grow at. And I'm talking about tier 1 here. Yeah. My sense is that versus a 7% kind of rate of growth between FY15 and FY20, industry will probably grow 100 basis points or 200 basis points faster because of digital transformation related uptick and stuff like that. My sense is that margins could be coming under pressure over the medium term. And this has been the case for the last 15, 20 years. Margins have been coming steadily under pressure. And especially for Infosys, I think one of the worries that I have of Infosys is that under Salil Parekh, while the revenue has grown quite fast, the EBIT growth has been actually along the lines of what TCS delivered. If you look at the EBIT CAGR between FY18 and FY23, it's pretty similar. So everybody keeps talking about Infosys growing faster, but that's been at the expense of margins. So those are some of the things that I could talk about. On tier 2, my worry is that the impact could be larger. I mean, it's a very idiosyncratic situation across various companies. But generally, I would say that the client exposure, the client concentration is far higher for the tier 2 companies. It just requires 1 or 2 clients to kind of pull back, and then your growth rates kind of come off very dramatically. The expectations are fairly high from what growth is going to be delivered by these companies. So, and the other thing is that last 3 years, I think there's been a significant margin expansion for certain companies. I think going forward, that could be a challenge for tier 2.
Okay, I think this has been a fantastic debate, and both of you gentlemen have been such good sports. So thanks very much, Girish, for stopping by and giving us your view, and Apurva, thank you as well for joining in, and let's see how this one plays out. Very interesting times ahead for Indian IT services.